Welcome to Illuminati Silver. We tell it the truth about silver. Today is Sunday the 28th of August 2022, and we have some very rocky months ahead in our view for gold and silver prices. Friday highlighted why. Let's take a look. Gold fell $8 last week, falling from $1,747 to $1,739, having hit a high of $1,765 and a low of $1,728, a lower high and a lower low than the previous week. This resulted in a fall of 0.5% compared with a 3% fall the previous week. In sterling terms, gold finished the week at £1,481. That's actually up £3. And in euros, it closed at €1,744. That's up €4. That just goes to show, relatively speaking, how weak the euro and sterling was compared with the US dollar. Silver fell 15 cents. Compared with last week's dramatic fall of $1.77, falling from 1907 to 1892, having hit a high of 1943 and a low of 1873. Like gold, a lower high and a lower low than the previous week, and a fall of 0.8%. In sterling terms, silver closed at £16.12. That's down just 1 penny. And in euros, it closed at 18.99 euros. That's down 0.01 euros. The gold to silver ratio rose from 91.6 to 1 to 91.9 to 1. Now, looking at the prediction we made last week, this is what we said. This coming week, we expect to see gold trade between 1700 and 1850, with 1675 and 1875 as outliers, and we forecast silver will trade between $18 and $20, with 1750 to 21 as outliers. Well, both gold and silver traded well within our predicted normal range, with gold showing a difference of just $37 between its high and low, and silver showing a difference of 70 cents between its high and low. So it did actually prove, with the exception of what happened on Friday, to be a relatively unexciting week, to be fair, with the biggest move happening on Friday. Now, we predicted that would be because of the PCE data being announced, but it transpires that wasn't the primary cause. Now, we shall look further into this after we've assessed the other financials for last week. Bitcoin's fallen $1,083, following a $3,431 fall of previous week. So it's now down almost $4,500, or just over $4,500 in 2 weeks, and it currently stands at $20,182. Equities were lower for the week across the board, primarily, but not totally, because of Friday. The Dow Jones closed on Friday at 32,283, down 1,008 points on the day, and down 1,423 points on the week. The S&P 500 closed at 4,057, down 141 points on the day and down 171 points on the week. The Nasdaq Composite closed at 12,141, down 497 points on the day and down 564 points on the week. So this means that for the year to date, the Dow is down 9%, the S&P is down 10%, and the Nasdaq is down just shy of 20%. Looking at oils now, slightly disappointing really. Brent crude closed at $100.99, so basically $101, up $4.27 for the week, and WTI crude closed at $93.06, up $2.29 on the week, just as we were getting into a nice downward trend. The dollar index stands at 108.8, up 0.63 on the week, and improving on last week's hike, which was the largest weekly advance for the dollar since March 2020. And we suspect it has further to go. So let's take a quick look now at the economic data announced last week in the United States, what happened to gold and silver prices thereafter, and what economic data we've got coming which could influence those prices. So let's take a look at what was announced last week and what will be announced this coming week in terms of economic data from the United States. Well, on Monday, we saw the Chicago Fed National Activity Index coming in at a positive 0.27 for July, compared with minus 0.25 the month before. Then on Tuesday, the S&P US Manufacturing Flash PMIs, now the Flash is an indicator, and of course we get the finals usually a week later. The PMI for manufacturing for August came in slightly lower than July, and slightly lower than expectations. And the services PMIs came in a fair bit lower than expectations and July. New home sales were also down in July compared with expectations and compared with June's figures. Durable goods orders basically unchanged. Core capital equipment orders a positive 0.4% for July, and pending home sales index down 1%, but better than anticipated. Then the initial jobless claims came on Wednesday and were actually lower, and so were the continuing jobless claims. So as far as jobs are concerned, the figures indicate a positive situation. Of course, we can all debate how many of these jobs are full-time jobs and how many jobs individuals are having. For example, one person may have 3 part-time jobs rather than 1 regular job. But this is jobless claims, so at least they are claiming work. Now, we stated last week that Friday was more than likely to have the biggest impact, though ironically, whilst we were right, it was not necessarily because of the PCE figures that were announced. In fact, the PCE price index on a monthly basis for July was actually down 0.1%, compared with a positive 1% in June. And the core PCE price index was up 0.1, compared with 0.6 the month before and expectations of 0.2. So this gives us a year-over-year PCE index of 6.3 and a core PCE index of 4.6. Disposable incomes were higher than the previous month, and consumer spending was also higher. However, nominal personal incomes, whilst up, were lower than anticipated, and nominal consumer spending was also lower than anticipated. What really moved markets is this point here. Fed Chair Jerome Powell speaks at Jackson Hole retreat, and we'll cover that in a second. And finally, we had the UMich Consumer Sentiment Index, which was higher than anticipated. Now, what do we have this coming week? Well, nothing scheduled for Monday. On Tuesday, we have the Consumer Confidence Index. We then on Wednesday have the ADP employment report, and the reason that's important is that it usually, not necessarily follows, but usually gives us a guide as to what to expect in the non-farm payrolls, which is what we will have on Friday. And we have the Chicago Manufacturing PMI. On Thursday, we have jobless claims, but we also have then the final manufacturing PMI from S&P and also the ISM Manufacturing Index, both for August. And then on Friday, the all-important non-farm payrolls and the various data that runs along with that, which includes the unemployment rate and average hourly earnings. We also have figures for July for factory orders too. So really important data. Tuesday, consumer confidence. Wednesday, ADP employment report. Thursday, manufacturing PMIs. And then Friday, non-farm payrolls. So, what did the Fed Chair, Jerome Powell, say at Jackson Hole? Well, Reuters give a very succinct report on that. So rather than us actually give you our summary, we shall just read what Reuters has said. Headline, Powell sees pain ahead as Fed sticks to the fast lane to beat inflation. Americans are headed for a painful period of slow economic growth and possibly rising joblessness as the Federal Reserve raises interest rates to fight high inflation. US Central Bank Chief Jerome Powell warned on Friday, in his bluntest language yet, about what is in store for the world's biggest economy. In a speech kicking off the Jackson Hole Central Banking Conference in Wyoming, Powell said the Fed will raise rates as high as needed to restrict growth and would keep them there for some time to bring down inflation that is running at more than 3 times the Fed's 2% goal. Quote, "Reducing inflation is likely to require a sustained period of below-trend growth," Powell said, while higher interest rates, slower growth, and softer labour market conditions will bring down inflation. They will also bring some pain to households and businesses. These are the unfortunate costs of reducing inflation. But a failure to restore price stability would mean far greater pain. As that pain increases, Powell said, people should not expect the Fed to dial back its monetary policy quickly until the inflation problem is fixed. So what does this mean in reality? Well, higher interest rates for sure, and a commitment to hold them at elevated levels until inflation is deemed to be thwarted and or contained. Now, most economists privately admit that with the national debt running so high and borrowing around 130% of GDP, of course the Fed is not going to raise rates to the ridiculous levels seen under Volcker in the 1980-82 recession, where rates rose above 20%. That is now an impossibility, and should that occur, then the dollar demise will be in full throw. However, what many believe is a potential for the Fed funds rate is reaching 3.5% to 3.75% this year, compared with the current 2.25% to 2.5%. In other words, during the course of this year, we could indeed see rates rise by another 1.25% to 1.5%. Now, it would not be unreasonable to see a 0.75% rise in September, followed by a 0.5% rise in November, and potentially a 0.25% rise in December, though we suspect that may not happen, the December one, if September and November happens, until January, especially if retail sales over Christmas were buoyant. If they weren't, then perhaps they may hold off further. This scenario, if played out, will provide headwinds for gold and silver. And if economic growth reduces as a result, severe headwinds for silver as industrial demand falls. As the household budgets are squeezed, then gold and silver retail demand is also likely to fall, so this scenario does not augur well for precious metals. Now, of course, if there is a worsening of the geopolitical environment, then there could be a flight to safe haven assets. But frankly, we're not holding our breath for silver, particularly over the coming months. Let's now go back to gold. Technical analysts predict that should gold remain below $1,740, that's $1,740, for more than a couple of days, a downtrend will likely result, potentially pushing gold as low as $1,694 in sharp order. However, should gold push above $1,776, we could see a move quite rapidly to $1,824, especially once that psychological 1,800 level has been breached. Silver held up pretty well, although it was down, considering Jerome Powell's comments, although it did fall on the day, and portrays some resilience around $18. Now, almost all analysts agreed that if this $18 level is breached and $17.50 below it, then we could indeed see silver fall to $15. Not in one jump, but over a period of weeks or a month or two at the outside. Some very bearish analysts are predicting potentially $12 silver, which cannot be ruled out, though if that were to happen, we envisage that occurring if we end up in a much worse than expected global recession. We need to see silver rise again above $21 before any confidence or talk of a potential bull market can be hoped for. But you can expect the pumpers to be out telling you now's the time to buy, because $30, $40 silver is on the cards. We cannot dictate or advise what you do. But let's put it this way, we certainly will not be buying it ourselves. Now, we're not totally convinced that Friday's fall in gold and silver have fully played out, and short of some serious geopolitical event occurring, we expect a follow-through next week in their fall. We're also expecting a bigger spread between highs and lows this coming week as traders attempt to interpret Powell's comments and its likely effect on markets. So with this in mind, we envisage to see gold trade between 1675 and 1775, with 1650 to 1800 as outliers. We forecast silver will trade between 1775 and 1950, with $17 and $20 as outliers. We are, frankly, envisaging more towards the downside than the upside. However, do you think differently? If so, do share your thoughts. Meanwhile, thank you so much for listening. If you haven't already done so, please subscribe to our channel, not forgetting to press the bell sign so you're notified of our videos as and when they're published. And we wish you all a safe, enjoyable weekend, bank holiday for those in the UK on Monday, and a prosperous week ahead. Illuminati silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.